So let's talk about the various facets of the balance sheet, including its usefulness as well as some of its limitations. The reason the balance sheet is so useful is because it allows us to assess two things. First of all, a company's liquidity, its ability to pay its current or short-term obligations, and also its long-term solvency, its riskiness, which is its level of liabilities in its capital structure, and its flexibility, its ability to borrow funds for a potential investment opportunity, such as merger and acquisitions. The limitations of the balance sheet are somewhat heavy as well. First of all, there's a very high reliance on estimates. For example, estimated receivables that we'll collect in the future, or warranty costs that we'll pay in the future, which we'll discuss both these later in the course. The biggest limitation of all is it does not portray market value. As we discussed in an earlier module, many of our assets are valued at their historical cost as required by GAAP, or Generally Accepted Accounting Principles. This is in sharp contrast to the IFRS. Remember those international standards that we had previously discussed? Which allows revaluation of PP&E to its fair value. Is everyone as confused as me on this huge difference in asset valuation? I see most of you nodding your head up and down, so I'm going to move over to the whiteboard to illustrate how we can make more sense of this calamity of rules. All right, so we just talked about some of the limitations of the balance sheet. The one in particular is it does not portray market value. So today I'd like to walk you through an example of that. The building we're in here at University of Illinois is called the Business Instructional Facility, BIF for short. We built this facility back in 2008 at $60 million. That was our historical cost, which is what GAAP, or Generally Accepted Accounting Principles, dictates we have to use for the valuation of that. If today we had an appraisal done on this building that said it was worth $70 million due to all the improvements we put in the past 9-10 years, that would be the fair value. Now, GAAP does not allow us to use fair value, but under IFRS, if you remember that was International Financial Reporting Standards, we can use fair value. So in that case, we would use the $70 million on our balance sheet. And if you think about this, it's a pretty big difference, right? One reflects historical cost, one reflects fair value. In my opinion, actually the IFRS is ahead of us here from a GAAP perspective. I would rather see market value or fair value on my balance sheet as opposed to historical cost from 10, 20, sometimes 30 years ago. And that's the analysis of one of the key limitations of our balance sheet. Okay, welcome back. Hopefully that whiteboard demonstration helped make that a little bit more sensical out of the whole asset valuation concept. It is a confusing area. Let's go on to discuss balance sheet classifications. Remember from last week the accounting equation. If you don't remember that, please review last week's videos. It's assets equal liabilities plus shareholders' equity, or A equals L plus SE. Let's discuss each of these elements a bit further. First of all, let's start with assets. These are the things we own. There are two types of assets. Current assets, those assets that can be converted into cash or consumed within the next year or 12 months. Examples would be cash, receivables, investments, and inventory. Each of these will be discussed in a later module. Our second type of asset is non-current assets, or long-term. These are assets that last beyond 1 year, such as property, plant, and equipment, PP&E, intangibles, which are such things as goodwill, patents, trademarks, and franchises. Next, let's discuss the liabilities, the things we owe to others. Again, there are two types. Current liabilities, those liabilities that must be paid within the next year. Such examples would be accounts payable, deferred or unearned revenue, as well as accrued liabilities. And the second type is long-term liabilities, those liabilities that extend beyond 1 year, such as long-term debt, as well as your company's pension and lease obligations, which those will be covered in much more in depth in the next course in the specialization. And finally, let's discuss shareholders' equity. What's left for our shareholders, our owners of the company? Assets minus liabilities. It's represented by paid-in capital, which is the amount that's representing the cash invested by our shareholders in exchange for their ownership interest in our company. It's comprised of both common and preferred stock, as well as additional paid-in capital. Next, we have retained earnings. This is basically the cumulative earnings over the life of the company, basically net income on our income statement, minus the dividends, or the portion of the earnings we give back to our shareholders. And then the third one, which is a little bit more confusing, is accumulated other comprehensive income, which is AOCI. And we discussed that previously as well in the prior courses.